Welcome back to the Money and Wealth Show. I'm Sterling Fox. Our special guest this week is Garth Turner. And Garth, just before the break, you indicated that it's time to look forward, to get active in the marketplace, but in our typically cautious, conservative Canadian way. It's going to serve us well in the weeks and months and possibly years ahead. So where should Canadians who want to invest, who are looking to their retirement, where should they go?
Well, there's no one answer, of course, because everybody's different, but I'm a big believer in having a balanced portfolio, and I think today, because we're in such a fluid situation, there is no silver bullet. It's not real estate, it's not gold, it's not any one particular asset. I think a balanced portfolio, Sterling is right, and it kind of depends on your age and your risk tolerance, but you know, perhaps a middle-aged, middle-class Canadian might look at a 60-40 portfolio, 40% fixed income, 60% growth assets. In the fixed income part of it, I would maybe have half in bonds and half in preferreds. You can get 4.25% now in a good corporate bond issued by one of the major banks. You can buy preferred shares in the banks, utilities, insurance companies going to give you close to a 6% yield. That's a great fixed income portfolio right there. And over on the equity side, the growth side, if you have a portfolio of a few $100,000, I would not buy individual stocks. There's too much risk involved right now. ETFs are much better, exchange traded funds. They give you the same exposure with very low fees, high liquidity. If they're own companies that have declared dividends, they're passed through to you. But most importantly, you get diversification. So instead of putting all your money into one bank stock, buy all the bank stocks through an ETF. To me, it makes a lot more sense. So by getting that kind of a balance, for example, last winter when the stock market went down by 50 or 60%, that kind of a balanced portfolio would have been down about 13 or 14%. So it's a lot easier to come out of that hole than a 50% hole. And I think today it is just the prudent thing to do. Get yield, look after some growth assets, but do it in a balanced way.
Good debt versus bad debt. If you don't have the available cash on hand, but are serious about pursuing perhaps ETFs or some other strategy that pays you dividends on a regular basis, is it smart at these historically low interest rates to borrow to invest in some of these stocks? Or in these ETFs?
These assets, absolutely. Sterling and Ken, let me give you one example. If you arranged a line of credit at prime, 3%, you borrowed $50,000, you went and bought $50,000 worth of preferred shares that are paying you 5.8%, how are you going to lose? Borrowing at 3, getting almost 6, and the return you're getting on the preferreds are dividend income, so 80% of it's tax-free. And meanwhile, the interest on your loan, you write off against your income taxes, so that actually becomes not 3%, but maybe 2%. So you've got a 4% spread. That's how rich people get rich. They use other people's money. But as long as you know there's leverage involved, so there's danger involved, you need to have, you know, good advice and be comfortable doing that. And if there were a minor glitch, you don't panic and sell. So
you're a former revenue minister, perhaps more acquainted with tax law in this country than most of us taxpayers. But you did make a point recently talking about the fact that with this unbelievable debt load Western nations are carrying, the tax increases are inevitable. It's just got to happen for governments to stay heads above water. So tax avoidance is going to be a very critical component of personal investment strategy, isn't it?
Yeah, absolutely. And I think we only need look at the HST in British Columbia and Ontario to give us a taste of what's coming. And that is definitely going to be a creeping level of taxation. I'm very concerned about that. And I think that most people who earn their money as typical Canadians do, and there are 3 forms: salary, interest on your GICs, or renting out some condo or duplex somewhere.
Investment property.
Those are the 3 ways that people make money. Those are the 3 ways government taxes at 100%. If you were to buy an ETF or a mutual fund and it goes up in value, you pay capital gains. 75% is tax-free. If you buy dividend yielding securities, 80% is tax-free. You get a GIC or stick your money in ING, you get 100% taxed. So People don't understand that. At the end of the day, it's not the return you get, it's how much you get to keep.
Right.
So earning your money in those traditions, there is a reason government taxes those things at 100%, because people are sitting ducks. So by changing your asset allocation and the way that you earn income, you can dramatically increase your overall yield.
And I don't want to sound like a broken record here, but this is worth noting because it's big for you. One of the means by which Canadians are being encouraged by the government to save, something we're getting far away from in most of our lives, is this TFSA, the tax-free savings account. But you're saying that ultimately, most of us make the error of using that savings account to actually save, and it's just not the most dynamic way to use it at all.
Yeah, I think the latest numbers show that about 80% of people who have TFSAs have put their money into savings vehicles.
Just park it, right?
Which is great for the banks, and they really don't want you to do anything other than that. Because if I'm the Bank of Montreal and I can get your TFSA and pay you 0.5 percentage point and lend your money out to some schmuck for 5% for a mortgage, I'm happy, right? But you as an investor are not getting the return on your money that you should, and you're wasting this tax vehicle. If you can put money inside a TFSA where it will grow 100% tax-free, and you can take it out anytime you want, but particularly in retirement, with no tax consequences.
Unlike an RSP.
Exactly. Yeah. You want this thing to grow as rapidly as possible. That's the place to put your growth assets, the ETFs, etc., not your skinny little savings.
All right. The book is Money Road. It's worth a read. And the blog, the website is greaterfool.ca, worth a pause in every day of your activities. Our guest, Garth Turner, thanks so much for dropping by. It's always good to have you on the program.
Thank you.
And we'll be right back.
Good afternoon. My name is Larry Ray. I'm the chairman and CEO of Molycorp Gold Corp. As the name states, we do have a deposit we're developing in British Columbia, which is a pure molybdenum deposit. But our focus these days is on magnesium in Nevada. Through serendipity, we discovered a large deposit of magnesium running about 10% with a high purity and consists of about 256 million tonnes at this time, 52 billion pounds. Our main emphasis is to move this project forward by beginning a drill program later this year in which we can increase the integrity of the resources into the indicated and inferred, as well as increase the resource itself. For further information, please visit our website at molycorp.com or phone us at 604-531-9639.
Tax Tips with David Ingram.
Restricted stock units. They're difficult to understand. Very few people do understand them. It's really important that if you get a restricted stock unit that you get professional advice. Don't make a decision on your own because of what the guy at the office said. That's a tax tip.
And that's our program for this week. Our thanks to David Ingram and to our special guest, Garth Turner. And thank you for joining us. If you have some thoughts about today's show that you'd like to share with us, we'd love to hear from you. Send them to comments@themoneyandwealthshow.com. I'm Sterling Fox. See you next time.
Comments made on the preceding paid commercial program are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time.